First of all, I would like to thank the Chamber of Commerce of Munich and Upper Bavaria for inviting me to present globalization from China's perspective. And I would also like to wish the Chamber of Commerce a very happy 175th birthday. First of all, we will look at, in the new era, what is called after the 19th Party Congress last October in China, how China is seen as a globalizing power. And we will look at the different aspects of globalization that China is going through and has gone through over the past couple of decades, like trade and including global value chains, how it's integrating and how it's disintegrating, and also investment and financial linkages. So probably it's worthwhile to start the whole discussion of China and globalization with what China means for the world. How important is China for us, for our growth, for world growth? Here I put some charts about how important China is for global economic growth. We can see that in the latest year, which was last year, China contributed about a quarter of global growth, which is slightly lower than its contribution in 2016, when it was a third, but still it's quite sizable. And its shrinking contribution is mainly due to the global recovery in other countries last year. Even though everybody, including us, forecasts some slowdown in China in the coming years, China's contribution to global growth will not shrink that much. So it will be still a quarter, a fifth or so. So it will still remain a major driver of global growth. Also, it is a major driver of trade growth. Its contribution to global trade is about 1/6, which is again, quite large. And when you see in the past 5 or so years, global trade deceleration, then you can also see the same picture in Chinese trade. So China is also going to be an important driver of global trade. Just starting with trade, China is already the largest exporter, followed by the United States and Germany, but there's a very big gap. So China exports about a third more than the US or Germany. But it has not always been like that. China started with just 1% of world's exports in 1982. That's when we have the first data point. And now its export share and import share, they're similar, are above 10%. So quite a big increase in just a few decades. And that's all related to the open-up policy of Deng Xiaoping from 1978. However, in recent years, especially in the past 5 years or the past decade, I would also say, both exports and imports are slowing. And this is also showing up in global trade. And there are also very interesting developments on China's current accounts. While the trade surplus is more or less stable, it has come down from the big surpluses 10 years ago, but it's relatively stable. What we can see is the development on the green bars on the negative territory of the right-hand side chart, which is imports of tourism services. So basically, this shows the Chinese tourists that are coming to Germany or all over the world. So because of these huge imports, which shows up in the accounts of imports of services, because of this, the Chinese current account is shrinking very fast. In the first half of this year, it has gone into a negative territory. However, we forecast that this will probably go back to positive. It's just a seasonal and also one-time impact. We have also heard a couple of minutes ago that commodity use is also part of the globalization, and China is indeed an intense user of global commodities. Here, I tried to put together some available minerals and raw materials, and we see that China uses in its production at least half or around half of global aluminium, coal, copper, iron, tin, zinc, and nickel production. So its production and also its exports are very commodity intensive. It's all known that China is, or at least used to be, the factory of the world. And that was mainly driven by foreign invested firms that established their factories in China. And they were mainly producing for exports. This was fueling China's growth by the expansion of the production capacity. But these foreign firms, they contributed very little to the Chinese trade surplus. This is very little known. Everybody thought that that is the common perception that it's foreign firms that produce China's trade surplus, but it's not. It's actually the Chinese domestic private firms that are the major, that are the producers of China's trade surplus. While the state-owned sector is usually recording a deficit because oil and other raw materials are imported by state-owned companies. Here we can see some signs of declining of a processing trade. This processing trade is something through which China was part of global value chains. So this means that companies, especially foreign companies at the beginning, are importing parts and components, and they are assembling in China, then they are re-exporting. So this type of model is now diminishing, and foreign funded enterprises, exports and imports are also slowing. Even though foreign enterprises' role in trade is not as important as it was like 10 years ago, but China is still an important destination for foreign direct investment. But now, instead of looking at it as a platform to produce for exports, now it's mainly its market that is attractive for investors. And also we can see on the right-hand side chart that it's more and more services that are favored by foreign investors, not so much manufacturing. And this chart shows a little bit of what we have seen in the past couple of charts, that foreign companies use China less as a production base any longer, and China's GDP participation seems to have already peaked. So there are some people who are saying that, does it mean that there's a de-integration of global value chains? And well, this might already be happening. This is the global value chain indicator, which very clearly got into negative territory according to the latest data. This is the famous TIVA, or trade in value added indicator that is produced by the OECD. And this, again, clearly shows that foreign value added as a percentage of exports is decreasing over time. And probably this trend will continue as China is catching up in terms of technology with the more advanced countries. And also given its inputs, very large inputs into innovation, and also a large number of outputs in terms of like patents and other innovation outputs. Probably this trend will continue. Now looking at the other side of investment, outward investment by China, it's becoming increasingly important. And actually, in 2014, China became a net capital exporter. That means it invested more abroad than the investment it received. But this was like a temporary phenomenon. And by last year, it again became a net importer of capital. But that was mainly due to the crackdown of capital flight by authorities. And now there's a new list of outward investment. There are sensitive sectors and there are prohibited sectors. So because of this new set of regulations, now it's much more difficult to disguise all kinds of money laundering or capital flight as foreign direct investment compared to before the new regulations. And actually, it's mainly the right-hand side chart, which is interesting, which shows that these regulations were effective. So as a result, outward foreign direct investment was reined in. And also, the shrinking of the foreign exchange reserves has stopped. Although China is still a very small investor overseas, as we can see compared to the G7 or the total world, but we can see also the trends that its investment is increasing very fast. These are the flows, but before this event, I was talking with people, and probably it's worthwhile to mention that although Chinese overseas investment is increasing very fast, in manufacturing, its share is extremely small. So when you look at the accumulated investment overseas in manufacturing, China has about the same stock as Korea. So it's not that large. And at the beginning, Chinese overseas investment was mainly concentrated in resource-based industries, mining, oil processing, then also services. So manufacturing investment is relatively recent. And now turning to finance, how integrated is China in terms of finance with the world? Probably here now we can see much more limited integration. We can see that China is the major driver of corporate bond issuance in overseas markets. This is including both the corporate bonds by enterprises. It also includes the financial bonds by financial institutions, and also the corporate bonds issued by the so-called local government investment vehicles, which are mainly the bodies that invest in urban construction. Because of the huge infrastructure needs, that's why also their corporate bond issuance is showing up. However, maturities have shrunk, and worthwhile looking at the right-hand side chart, a very little of corporate debt is held by foreigners. So it's about 2% or less than 2% of bonds held by overseas entities. So the exposure of Chinese corporates to the overseas world through the financial sector is extremely limited. And this is just about the share of debt securities in non-financial corporate debt. It's increasing in China. And an interesting development is that while the share of foreign currency in total non-financial corporate debt securities is increasing in emerging economies as total, but in China it is decreasing. So Chinese bond is increasingly issued in domestic currency. And turning to the banking sector, also its exposure to China is extremely limited. So foreign banks' exposure is 2-3%. This is the latest data available. So summing up, China is very much integrated into the global economy in terms of trade, in terms of investment, especially inward investment. China is still a very important and attractive destination. In terms of outward investment, it's still a very small player, but its role is increasing. But in terms of financial markets, it's almost like completely isolated. That's why when looking at, for instance, different kinds of financial risks or different financial events that we see in the news every day, probably their impact on the global economy would be very limited, exactly because of these extremely limited linkages with the outside financial system. Thank you very much.